welcome back. I'm joined now by David Morgan. He's the publisher of the Morgan Report and a self-described precious metals aficionado. David Morgan, thank you very much for joining me today. Welcome to the Power and Market Report. How are you?
Albert, I'm great, and thanks for having me on.
It's my pleasure, my pleasure. You are the silver guru, and I saw a great interview actually you did over at USA Watchdog talking about the silver shortage. So why don't we start there? Silver has been in short supply for a while. Is this still the case? Are we still, I forget what it was, millions of ounces short? Is that still the case?
Well, right now the retail market is still very, very tight, and there are delays anywhere from, depending who you speak with, 4 weeks, 6 weeks, 8 weeks, in some cases 12 weeks out, depending on the product. So certainly on the retail side, the word shortage definitely applies. The bigger scope, of course, Albert, as we discussed pre-interview on the phone a few days ago, is does that mean that there is a quote-unquote silver shortage? And this is where it gets a little more difficult to analyze, although certainly we can address that later. But for right now, the silver market is basically on fire at the retail level, and almost all products are being sought. In other words, 100-ounce bars, 10-ounce bars, 1-ounce wafers, generic rounds, and of course the mints, the government mints, are way behind. The U.S. Mint is allocating the amount of silver that they'll give out to their dealers, and the Canadian Mint is basically closed down for a while. The only one that's really producing at this time that's trying to meet the demand is the Australian Mint, the Perth Mint. And I just read in Reuters today, just before the interview, that they're setting, they're setting a record volume. Well, of course they are, because the demand is so high. So it seems as if the most recent information I have is that the orders now that are coming in, the smaller scale retail investors kind of backing off. In other words, a lot of people have come in the market and waiting now for their silver delivery. But larger orders are coming in now. So, where this ends up, nobody knows for sure. Certainly we can talk about it further if you wish.
Okay, now it's not a surprise, I guess, that government mints would be behind the curve. This seems to happen every couple of years, but this is also private mints. Like you said, the demand is, or the shortages go all around, right? So it's sovereign coins, it's rounds, it's ounce bars, 10-ounce bars. Where's the demand coming from at the retail level, or why is there so much demand for silver right now?
Well, I think why is a better question, and it's because the price is so low. I mean, we did a study for our website members of the Morgan Report, and if you do it on a true money supply basis, the amount of funny money out there relative per ounce of silver is basically at the same ratio it was back when silver was at around the $5 level in the early 2000s. And let me go a bit further. If you take that level, the $5, under 5 actually, in the early 2000s, and you inflation adjust it, that was the lowest price silver on an inflation adjusted basis ever in recorded history. That was lower in real terms than 22-cent silver was in the Great Depression. So now what I'm saying is that on a amount of money printed basis, the $16 level approximately is the same as $5. Now that doesn't mean that it's costing 5, I understand that, but what it means is if you adjust it to the amount of printing that's gone on from the early 2000s to today, you're basically paying the same ratio. So it's very undervalued. It's undervalued relative to primary silver miners. It's undervalued relative to gold. It's undervalued relative to the Dow Jones. I mean, just about any metric you want to look at, silver is a screaming buy. So there's an amount of silver bulls out there that understand, not maybe what I just explained, not every detail, but they know very well that silver is very undervalued. So they're coming in, and these are new buyers. These are buyers that buy on a methodical basis every month or every quarter or whatever. And of course, there are people that are considered silver stackers that buy almost regardless of the price, on and on. And you have a lot of people that are savvy to the big switch, meaning we're moving from the equity sector back into the commodity sector uh, approximately now. Now is a great time to be shifting out of equities and into commodities, especially the metals.
Certainly, if you look at the relative value, that makes a lot of sense. Put up a chart here of the silver price coming down from $50. It's either a price of a chart of a very good opportunity or a picture of silver investors wanting to jump off a mountain. It's just been terrible. But you're right. If you look at the relative value, you assume that it was fairly priced at some point in there. It's gone straight down. And then in the meantime, for 3 years or so, the stock market's gone straight up. And I would agree. It makes sense that there would be at some point it makes sense to switch over. We'll get to stocks a little bit later, but I want to talk about now going away from the retail market, just portfolio silver. Is there a shortage there? And if there isn't, is there an arbitrage opportunity? You would think that people at some point would be melting bars and pressing rounds to take advantage of this price differential.
Well, there is an arbitrage opportunity. This took place in 2008 as well. In fact, I did it myself. I bought 3 1,000-ounce bars off the exchange and had them shipped to a friend of mine that owns a mint, and he minted those into 1/2-ounce rounds, and you could make a pretty good spread. That opportunity still exists today. The problem is that the demand is so high on the retail side, you would have to still wait. In other words, you could call up a mint master somewhere, make a deal with him to press them out at, let's say, 50 cents a coin or 60 or 70 cents per coin or per round or medallion, depending on what we're speaking of, because you can't really call it a coin unless it's a government issue. But regardless, you would have to basically be a bit patient. So you would buy, let's just go small. Let's say you bought one contract, 5 1,000-ounce bars, and let's say the total is like 4,889.25 ounces. So he would have to take that and process it and press them out and send them to you. In that time, you may see the premium come down. So there's still a risk involved unless you can shorten that arbitrage time. Albert, you're taking a bit of a risk. Of course, you could lay that risk off in the futures market if you wish to. So can it be done? Absolutely. Is it being done? Not much. The last time in 2008, I was asked to consult for a silver processor that did nothing but industrial type of silver products, which would be like plate, wire, shot, all kinds of silver products that's used industrial side only. And I told them what was going on with this arbitrage opportunity, and they basically didn't close down, but they lightened up significantly what their industrial usage demand was and went to pouring 100-ounce bars for the retail market. And they took full opportunity on that arbitrage that was available. So does it happen? Yes. Will it happen this time? It probably is in some small cases. Again, the problem being is that when you're pounding out as much as you can, you got to get in line, and that means there's a delay and no one knows the future, so you've got to take a bit of a risk.
Okay, so that sort of makes sense. I think this is sort of what happened last time too. It's not like there wasn't silver in the pipeline. It's just that it takes a while for that to work its way through the system and come out the other end as a retail product. Is that what you're saying?
It's exactly right. I mean, there's some people that get a little upset, but those are the facts. I mean, for example, I gave the example of 12-week delivery. Well, if you go to the Sunshine Mint, which is like one state over from where I'm sitting right now, and you order their rounds, the Sunshine rounds, you're going to have to wait about 12 weeks. Well, why is that? Because they put out the planchettes or the blanks for the U.S. Treasury to make silver eagles. In other words, government minted coins. So they are doing everything that they can at full capacity to put those out. So the silver that you would want for their own product is on the back burner, so to speak. So you're going to have to wait even longer for that product. So you can see this thing starting to back up. And my concern, Albert, is that how far does it back up? Right now, round numbers are probably waiting for about 5 million ounces to flow through the system on the physical side. If you look at 5 million ounces versus 7 to 750 million ounces that are mined on an annual basis, that's a pretty small percentage. But we both know that markets move at the margins. So if 700 million of those ounces are tightly held and not going anywhere, and the float is very, very tight, then if we go from 5 million ounces to 10 million ounces, that might put some real strain even into the commercial bar market. And that's what I'm keeping my eye on almost daily. I've spent a couple hours this morning talking to different wholesalers on what the demand was and how they're meeting it and that type of thing. And I don't want to drive down to this thing too far. I mean, it probably will, take care of itself over time. But if it continues and if there's more and more pressure, you could see even further delays.
David Morgan joining me here. I want to talk a little bit about the Federal Reserve and interest rates. It's a related topic. I certainly can't talk about silver or gold, or even the stock market for that matter, without getting into central banking policy. They just shied away from a rate hike, and we're going on almost 7 years of this 25 basis points or less. How long do you think this can go? Do you think we're going to have a rate hike this year, early next year? And what do you think will happen if that is indeed the case?
Well, I don't think it can go on forever. I'm already on the record as saying I think they'll do it before the end of the year. I'm not even sure they'll do 25 basis points. They might do 0.125 basis points. They might do an eighth of a point rather than a quarter point. I don't know. I think they will, just to kind of save face. I think at that low level, it won't really have that big an effect. Of course, there's so many derivatives around the interest rate matrix. I mean, everything has to deal with cash and money and all the stuff in the financial world, as you well know, Albert, and it has to do with what is the cost of money. So any variable up, somebody that's made a derivatives bet that's highly leveraged, even a quarter or an eighth of a point, could have an effect. So I'm well aware of that fact. In the overall scheme of things, if the system is that fragile that a quarter point raise would cause the system to crash, we're really in trouble. And we really are in trouble. I want to throw that in there. But I think there's a possibility that'll happen. Longer term, the Fed is in a box that they can't get out of. They're keeping interest rates low to save the government's ability to be able to service the debt. Because as interest rates go higher, it makes it much more cumbersome for the government to service the outstanding debt, and that's the real crux of the issue.
Yeah, now I agree that, and a lot of people actually who are looking at this say the same thing: a quarter point, or an eighth point, or 16th, whatever it ends up being, is not going to be a big problem. But the problem would be if the market tries to discount the entire 3%. And I guess the old market would have done so. If we were back in 2000 again, they started a rate hiking cycle, they would have discounted 3%. Now with all this data dependent stuff, who knows, maybe the Fed raises twice and then stops. What do you think? If they start, do you think they're going to go all the way to 3% or whatever the target is? Or do they get scared and back off in the middle?
Well, I agree with you, Albert, or what you implied, and correct me if I misunderstood you, but I think that going to 3% is probably fatal to them. I mean, the system is that fragile. A quarter point, maybe even a half point, maybe even a 1% or something. System could probably handle that, but to get to 3%, I doubt it. And if I'm wrong at 3, I'm certain 6 is impossible. Because again, there's so many related derivatives on these interest rate bets, and so much is at stake, and the inability to service the debt once it starts getting at a higher interest rate. The problem is that even though the Fed sets the discount window, and of course all the bond traders pretty much go along with what the Fed does, it doesn't mean it's going to happen forever. So back in my youth, we referred to the bond guys as not only the smartest guys on the street, but many referred to as bond vigilantes. And back in the early days, before the big derivatives issues, we used to look at what the M1 supply was. So when M1 was spiking up, you would see the bond market fall off because, as you well know, interest rates are inversely proportional to the money or to the money supply. In other words, when bond prices are high, they get higher if interest rates go down, but if interest rates go up, the bond prices go down. And that's, of course, the biggest fear out there, because if people, and these are not just people, certainly there's people that own T-bills, but really it's the big players that control the system. It's the government entities and these large brokerage houses that have everything at stake in a stable bond market. And they all know they're playing a very treacherous game. So if one of them tries to leave the system, let's say, or lighten their position in a rather substantial way, they're going to take down the entire ship with them, because once the exit starts to go and there's a big sale in the bond market, you're going to see a lot of panic selling. Now, this is controlled. This is very much anticipated in these high frequency trading systems, the Working Group on Financial Markets, and all kinds of, let's say, brain power is out there in computer form and otherwise to mitigate that type of a situation. However, what we learned from long-term capital management is human behavior cannot be predicted 100% of the time. You can actually predict human behavior fairly accurate part of the time, but you can't do it all the time. And this is the problem. I don't care who's running the computer, what algorithm's been written. The probability that something will go awry is just human nature. So the bond market really scares me. I haven't owned a bond in a very long time, and the ones I own were just basic savings bond, and I cashed those out years ago.
You know, there was an interesting report out of Bank of America talking about the high yield market and how liquidity is just, I think they called it a slow motion train wreck in progress. And it's something that I think Carl Icahn also referred to. You can take these things and put them in an ETF and slap a fancy name like BlackRock on them, but it doesn't change the fact that liquidity is becoming an issue. Are you concerned about the high yield market?
Oh, absolutely. I mean, I used to do a little more in the bond market than I do now, not owning them but trading them. Nonetheless, the whole thing about high yield is that risk and reward are not necessarily commensurate. In other words, a high yield means a high risk. And that wasn't always the case. If you go back into my youth again, one of the big traders on Wall Street started a high yield fund and did very well because his study, and I forget where he did it, one of the name brand schools, was that, they weren't really correlated that well. That may have been true in the 70s, but it's not true today. I'm very worried about the interest rate market, the bond market, the debt markets. And as you know, reading the book, I take about 3 chapters to explain it and lay it down, from a foundational level through the derivatives process and how that affects bullion banking, and eventually how the debt bomb is in an untenable position that it has to be resolved one way or the other. And again, to repeat myself, doesn't necessarily mean there'll be an orderly market when it's resolved.
Yeah, and you mentioned something very interesting in your interview. You're talking about how you didn't anticipate this going as long as it has. Certainly many of us on the bearish side did not. And basically you explained it by saying, look, you didn't really anticipate this global banking, right? I mean, it's, a Ponzi scheme needs more people to offload the losses on, essentially. And global coordination has been the key, hasn't it? And this is something that I didn't anticipate either. I didn't anticipate the degree to which the central banks would coordinate their QE and bring new people into this, what's kind of a scam.
Well, exactly. I can't say much more. I mean, I could go on, but I mean, I remember reading Bankruptcy 1999 when the Grace Commission came in under the Reagan administration and found all these areas that they could cut and really save the government money. And a lot of it was just, fat. It was stuff that really could be trimmed and really wouldn't hurt anyone. But, they paid for the study, they did a great job, and the Grace Commission came in and left and nothing happened. And that was, again, from more of a worldview that, there's these sovereign nations and they take care of themselves, not this global dominant banking empire that's going to control the world with the money supply. But that's basically where we're at. I mean, you look around and see, where the most skirmishes are, polite word for war. And this is basically in areas that haven't adopted the Anglo-American banking system.
Yeah, absolutely. Can we move on now to the equity markets? We had the S&P, the Dow, and the NASDAQ all finishing down this quarter. That's, I believe it's 2 consecutive quarters down for the S&P, 3 for the Dow. And the NASDAQ is just coming off a streak, I think it was 10 consecutive quarters up, something like that. And that streak's gone now. So we're down about 7-8%. Is this just the beginning?
I think it is. And again, coming back to your question about the Fed, this makes it tough when you get into the official recession territory. It makes them hard to raise interest rates again. But I think that any metric you use to look at the equity market as a whole, it's overvalued. And if you look at technical analysis the way that I do, we've been in what's called a high-level distribution pattern for a long time, and now we're starting to see the markdown. And this is where the pros have gotten out of their positions, and a lot of them have gone short, or they're just playing swing trades between, a couple of support levels. But overall, any way you slice it, if you look at it objectively, the market is overvalued, and that means that it will come down. And we just hope, personally, in my opinion, that it happens rather slowly. But the problem is, knowing the markets the way that I do, is markets always go down faster than they go up. So there's again the working group on financial markets and all this brainpower I referred to earlier, and they have mitigated these type of situations as much as humanly possible, which means that they've got circuit breakers. So if it starts to fall too fast, you just can't trade for 2 hours, and then they put everybody back online, and yes, you can trade again. But again, I'm of the belief, and also proof with long-term capital management and other anomalies that have happened over my financial career, that just because you think you can prevent something from happening doesn't necessarily mean that you can or you will. So this is a situation, again, Albert, that I think once the cat's out of the bag, so to speak, as a metaphor, we may see people that thought that they'd stand by their position no matter what, changing their minds and either going short or bailing out or selling positions they didn't want to, or what have you. And the government's good at coming in and changing the rules and saying, well, you can't short anymore, you can't sell anymore, or whatever. We saw that in China, but it really didn't mitigate the problem. Human nature is something that really isn't predictable, again, 100% of the time. Certainly you can make models and get ideas and get ads on the internet based on what your buying habits are and all that stuff. Is behavior predictable? Yeah, somewhat, but not 100% of the time, especially when it comes to high emotional levels, greed and fear. Those two are very indeterminable at certain times.
Yeah, that's a good point about China. And to stay with your metaphor, the cat's going to get out of the bag somehow, right? It might not be from the top, it might be from the bottom. It's definitely going to get out. And I don't even know if we're looking at the right bag. I mean, you can look at the S&P down 6.9 this quarter, which was obviously not a good piece of news, but more than half of the stocks within that index are down over 20%. So more than half the S&P is already in bear market territory. And then if you look at the NASDAQ, it's down 7.4% this quarter, but the biotech index within that is again down over 20% in 8 days. So you're looking at bear market there. Are we even looking at the right bag?
Well, good question. I mean, if you're pretty studied, and you are, obviously, I know you are, but you look at the advanced decline line. I mean, you can see all these stocks are making new lows, but yet the index is going up. And why is that? Well, if you're a sweetheart trader and you write the right algorithm, you can move 30 stocks like in the Dow and make things look good, but the overall underlying fundamentals of the overall market are rotten. And that's what you just alluded to when you see new lows in 50% of the market, or that type of thing, and yet the index looks solid. You're not going to hear that from a mainstream financial media. You're going to hear what the index is doing. You're not going to hear that at least half of the stocks that make up that parameter are doing horrible, because that's the truth. And truth is a very, very precious commodity that you don't get much of these days.
Yeah, that's definitely the truth. Now, summarizing though, David, so bonds obviously are a dangerous proposition at this point. The equity markets looks like it's heading for a losing year, and if you ask me, I don't think it's done. You probably would agree.
Yes.
Silver is undervalued, but very volatile. So what is the investor to do? Certainly can't go big into silver if you're a regular investor. Certainly as a speculation, it looks very good now. If you're Eric Sprott, for example, it looks very good. But he has an interesting perspective on risk. He says, I take a lot because, frankly, I made a lot of money and I can afford to do so. The average investor can't. So what are the options? Certainly maybe a small position in silver, gold as well, but what is the average investor to do in this environment?
Well, I was asked to write the 10 Rules of Silver Investing way back in, I don't know what it was, 2001 or two, something like that. And I said at the time the 10th rule was no matter how good an investment is, don't overdo it. And I recommended a 10% position. And a few years later, I upped that to 20%. But Ibbotson and Associates did an independent portfolio analysis and figured in today's environment, 15% is about the right amount. And this is hard metal, not mining equity. So I think you don't have to overload. I think that 10% for most investors is plenty. Definitely make sure that you can touch it, or if you do store it, make sure you know who you're storing it with and what the parameters are. And then you should be fine. I mean, I am not one of these that says, it's all crashing down and, there's no commerce going on from here on forward. Although not many of my peers say that either. But I do think, and to be consistent, that we are going to face times in the future, and I think it's going to be fairly soon, meaning in the next 2 to 3 years and perhaps earlier, that there's going to be some type of a reset. And that doesn't mean, again, the commerce stops. It just means that the way we transact may be different. Our priorities, I think, are going to shift greatly from what they've been in the past. And this is just a natural order of things. This is something that takes place if you study markets throughout history. It can only grow so much. So we're in a paradigm now where the growth structure is being questioned, not only academically, but in the real world. And I want to touch on the commodities briefly, Albert, that I'm not so sure there's going to be a huge shift to the commodities markets, although there could be, rather than the equities going to commodities. But I think that big move from like 2000 to 2010 was about it. I think that we're going to see a shift into what I call the top tier of all commodities, which are gold and silver, because that's a special case. That's money that's outside of the financial system. That's something that's been recognized as money for thousands of years that you can hold, that is not beholden to any counterparty at all. In fact, it'd work in an electronic problem. If you had an electronic problem at, say, the NYSE as an example, or your local bank, and you had silver or gold coins, they're certainly outside of the system. Now, I'm not predicting that. What I'm trying to do is give a clear, concise thought process to your viewers to think about what else could you own that would have that much value per unit that's universally recognized as money for thousands of years. I don't know of any other thing.
No, me neither. Are you predicting more pain ahead for the industrial metals?
I think so. The only one we really like on that side is zinc. We did a zinc study a few years ago, but nothing really happens fast very often. I mean, something could happen. It could be an anomaly. A black swan could hit another one. And certainly there's a lot of tension in the market right now, and we're doing this early October. But, there's so much momentum in the human spirit, let's call it, that they like that, generally speaking, things do not happen that quickly. In other words, adjustments can be made. You can course correct. You can find out what's wrong and make a change and that type of thing. The overall problem is the structure of the system is unsound. That's where that cat gets out of the bag, whether it gets out of the top, the bottom, or claws its way through and makes a new escape. It's coming out, and once it's out, everyone will see it. And that's what concerns me, is once everyone sees the cat, what are they going to do about it? Well, I believe there's a human financial instinct or survival instinct, just like there's a survival instinct. And when that happens, this brokerage house or that boutique broker or this rich investor or this poor investor is going to go to something that they trust. And there isn't much trust left in the system. And the thing that's the least trustworthy is something that's touted as the most trustworthy, which is a government bond market.
Another question for you, David. What do you think about platinum? Kind of rides the boundary between the silver and gold and other industrial metals. I think it took a hit recently because of the Volkswagen scandal. What do you think about platinum?
Well, I think it's at a 6 or 7 year low right now. I'm favorable to all the metals. Platinum and palladium really act as industrial metals, although they have the characteristics of precious metals. I think it's probably a little bit overdone right now. I think if you're a long term with a 3 to 5 year horizon, you could probably start to get in here and nibble at the physical market, or if you want to play it with the equities, which are very few, or an ETF, be my guest. It doesn't quite carry the clout that gold does. Nothing really does. Silver doesn't either. I mean, gold is something that's still very much held by the establishment, although they deny it daily. A lot of the central banks still have gold positions, and you're going to see, and central banks have been gold neutral to gold positive for quite some time now. They were net sellers up until a few years ago, but they've been net buyers, and that's something that you never hear on the mainstream press. So platinum, I like it. I wouldn't overload. Let me say one more statement. Platinum is something you would add to a metals portfolio. If you had a good gold and silver position, you wanted to add some platinum to it, great. If you just want to speculate, I'm not going to tell anybody how to trade or how to run their lives. If you want to speculate in the platinum market, is it a good time to start? Yeah, I like to watch markets make a move before I get in. So I would put a line on a chart and say, once you go through that on good volume, then I'd go long. I would make the market show me that it was ready to go higher, rather than tell you, on this interview, now's a good time. I want the market to tell me it's a good time.
One group that's not denying that they're accumulating gold anymore is the Chinese. They've moved up. I saw a report recently that they're, I think, is it fifth, right behind France now in terms of gold reserves, and I could see them overtaking France at some point. What do you think that signals?
Well, I think it signals monetary history. I mean, if you look at the means of production, which an Austrian economist would say is capital, that whoever is producing the most ends up with the most gold. And if you go back to the British Empire, they had the most gold and they were the biggest producers. And then it shifted to the United States and they were the biggest producers and they ended up with the most gold. Who's the biggest producer now? China. And who's going to end up with the most gold? Chinese. We have a little special section in this month's Morgan Report that'll be issued first weekend in October. And I go through why I believe that the amount reported is not really that accurate, but still maintains the parameters of what they were asked. If I asked you, how much clothes you have at X location, and you told me that might not be your entire wardrobe. I'm trying to think of a corny analogy here. So there's some information I have for our readers that may point to the fact that the reporting amount that China gave was accurate, but not the total picture. I believe strongly that China has more gold than they have reported recently.
Very interesting. I know you got to run, David, so just one more question. Oil's been beaten down for quite a while. What's your take on that? Is this going to continue?
I don't think it will. I mean, oil is the king of all commodities. Let's face it. I'm not an oil analyst, but nothing happens without energy. Everything works on energy. And without energy, we can have the civilization that we have. And that mostly means oil. So because there is the desire to achieve and make better things and that type of thing, we can get more efficient using oil. Nonetheless, the population growth isn't subsiding. Certainly it's curtailed with China's one-child policy. I'm not saying that doesn't exist. What I'm saying is the growth curve is still there and it's still expanding. It's slower, but it's still growing. So because of this, on a per capita basis, that means more energy per person, which right now means more oil per person. So I don't see how oil prices can stay low forever. And if you really study the market, I have friends that do, and they brief me, so I have a better understanding than maybe just a cursory look, is that it concerns me going out, say, 3 to 5 years, if there'll be enough substitution or we're able to get more efficient or on and on. I certainly, again, don't know everything, but I do know is that energy is the most important commodity, and we are getting a gift right now. But to think it's going to stay in this area for an indefinite period, I think is incorrect. I think that we really have to look at longer-term strategies. And let me just add on, Albert, that that's one thing that has really bothered me from my 40 years in the markets, is how everything in the U.S. seems to be so short-sighted on, the next quarter or the next half year or that type of thing. Whereas you take the perspective of the Asian mind or the Chinese, they're looking out, 2, 3, 4, 5 generations. And I think that's the better way to look at it. You have to put these things in perspective and look at what are your energy needs going to be, 10 years, 20 years, and how are you going to get there, and what alternatives are available, and what's the best method to make transportation for a big population or a small population? What's the best way efficiently to house people, and all those type of questions. And these things, I'm certain, are looked at even in the United States. I'm not saying they're not, but boy, the wheels turn very slowly, and that concerns me because we might have another oil hiccup sooner than most people anticipate without a strategic plan to take care of it.
My guest has been David Morgan. He's the publisher of the Morgan Report, author of the Silver Manifesto. You can check him out at silverinvestor.com. That's silver-investor.com, where you can take advantage of a free trial on the newsletter. David, thank you so much for joining me. I really enjoyed speaking with you, and I look forward to doing it again soon.
Thank you, Albert. I appreciated your questions.
And don't forget to visit powerandmarket.com for insightful interviews with the world's leading experts in economics, finance, and investing, like David Morgan.